Hey everybody, I'm Mike DeSepoli and welcome to the Ask the Advisor show brought to you by Heritage Financial Advisory Group. This week it's episode 100 and we're going to talk about 3 overlooked keys to being a successful investor. You know, for many people out there, the thought of investing strikes fear in their hearts. But here in our office, we have a different view of the concept of fear. We like to think of it as false evidence appearing real. And that definitely seems to apply to investing, and here's why. You know, we know the stock market makes people nervous, and it's especially true for people that grew up through different periods of recession and economic downturns. Not only did these people see extreme levels of market volatility at its worst, but they've also seen different things happen in the markets and the economy that leaves them with negative impressions about investing. And the truth is that the market is neither a one-way ticket to riches, and nor is it a dangerous game for insiders only. So we want to give you a couple things here to focus on to help give you that long-term success that so many people seek, yet are unable to deliver those results. So the first thing I want you to understand is that the market tends to move in long cycles, okay? And this is increasingly difficult for investors to understand because with technology as it is today, we can check our accounts weekly, we can check them daily, we could even check them hourly, and people are very in tune to their investments. But the reality is the market and your financial plan is geared towards the long run. So these little day-by-day gyrations shouldn't be enough to push you off your path, yet many people get sucked into the minutia and they get sucked into the daily moves of the stock market. And obviously it's an emotional thing and it tends to affect their behaviors around money. Now, what we want you to consider is the history of the market. So we looked at 1926 through 2018, and we looked at 2 different types of markets. Bull markets, which is when markets are trending up for sustained periods of time, and bear markets, which is when markets are trending down for sustained periods of time. Now, this information came from First Trust Investments, and they found that the average bull market lasted about 9.3 years and generated gains on average about 480% during that period of time. Now, bear markets, which are those downturns, lasted on average about 1.4 years, and markets trended lower by about 41% during those periods of time. So when you look at the longer term scope of the markets, bull markets historically last much longer than bear markets, and they produce outsized returns. So it's very important to keep a very long-term focus with your investment planning. And when volatility strikes, patience is usually the best course of action. Again, your long-term plan, your financial plan is geared to your long-term goals, not to the day-to-day gyrations in the market. So remember that. Second thing we want you to consider to pursue the objective of being a successful investor is that you need to make consistent contributions to your portfolio. You know, besides struggling to accept the volatility that markets present, many people are skittish about markets because they feel, powerless over the grand scheme of things. Money goes in and they really don't know decades later how things are going to turn out. And oftentimes the biggest factor that determines the success of your investments is simply contributing to your accounts on an ongoing basis. You know, this allows for when markets trend lower, you're able to put money in and buy investments at cheaper pricing. We call this dollar cost averaging. Okay, so consistently adding to your portfolio over time has proven to be a much better strategy than just trying to add all the lump sum at one particular time and pick the perfect moment to do that. Nobody really knows when the perfect moment is, when the top of the market, when is the bottom of the market. So if you make long-term contributions over extended periods of time, you will be much more successful in the long run. And the third thing we would implore people, and this is really the most important, so listen up on this one, we would implore you to focus on the things that you can actually control. To be sure, part of investing involves risk, and part of investing involves uncertain circumstances and outcomes that may occur in the world. A hurricane could happen on the other side of the world and cause an economic impact over the short term. We have elections. We have geopolitical turmoil. The Federal Reserve could raise interest rates, which could set off a market correction. These are all events that are outside of our control. Now, if you understand that volatility is not a malfunction of the financial markets, it's just a tax that investors pay to reap the longer term rewards, you may be much better off in sticking to your guns and holding firm on your strategy. So let's think about what are the things that we can control. We can control our behaviors, our emotional behaviors around money, how we don't react to different knee-jerk events in the economy. We can also control, alluding to the second point that we made, the amount of money that we put into our accounts, the contributions that we make. So we want to implore people to focus on those different things, focus on keeping a long-term objective, focus on adding to their accounts, having contributions on a regular basis. We find that many people out there are trying to save about 10% of their income into their investments, which is great. The more people saving, the better. But we would challenge you, can you get to 15%? Can you get to 20%? Remember, the more that you put in today, you're just buying days in retirement down the road. Okay, so it's important that you have discipline when it comes to adding to your accounts, keeping your contributions consistent. Don't try to time the market. Try not to be emotional. I know it's easier said than done, but if you focus on the things that you can control, you will certainly be better off than those that are trying to jump in and jump out of the market based on gut feelings and emotional reactions. So that's 3 definitely overlooked tips to being a successful investor. We hope you get some value out of this. If you have any questions, feel free to reach out to me. We always love discussing these things with you, personal finance, investments, business, whatever it may be. And on that note, with today being episode 100, we just want to say thank you so much for your support. It's really hard to believe that it's been 100 episodes here. We hope we have several hundred more to go. And at the end of the day, none of this would be possible without the viewership and the support that we have from our clients, from our online community, and from everybody that supported us and been along for this ride. So thank you so much for tuning in to the first 100 episodes, and here's to the next 100. We'll see you back next week for episode 101.